Welcome to another episode of the Maurice on Home Show, where we talk about real estate, life, love, and today we're going to be talking about insurance. We've actually never spoken about love, that was a lie, but maybe one day. So we have a special guest with us today. Her name is Shanecia Gordon, and she is certified as an LLQP and a security specialist. I know I got that wrong, but she will correct it for me. Please introduce yourself for anybody who doesn't know you. Let them know who you are and what you do.
Hey everyone. So like Maurice said, my name is Shanecia. He's correct. I am licensed as an LLQP, I guess you can say professional, and also a securities license. So that's basically on investments for those of you who are familiar with the terminology. I've been licensed for the last 4 years, right? And I'm actually in the process of opening up my own financial brokerage, hopefully by the grace of God by the end of this year. But yeah, anything else you want to know?
A lot we want to know. Actually, I've actually asked a lot of questions to...
You got questions.
I got questions. So we're going to start it off, get right into it.
Okay.
We do have a question where somebody wants to know, what are some principles that can start with helping to control and better help financial independence?
Okay, so it's pretty simple.
Yep.
The concept behind like financial independence, it's yeah.
Sorry.
Yeah, he said he's gonna get comfortable. Yeah, get comfortable. So first and foremost, to get to FI, financial independence, right? You've heard this before, and it's going to sound like taboo, but really you do have to live below your means,
Okay.
right? So if you have a certain income and you know, okay, I'm capped at, say, maybe I make $60K a year, a lot of people are like, okay, well, that's not enough for me to do all the things I need to do and get to financial independence,
Okay.
but you have to live below your means.
Okay.
One of the concepts that we teach our clients is always pay yourself first, okay? Now, unfortunately, most Canadians are taught to pay themselves last. So that means all your bills come in, you know, your mortgage, your rent, whatever the case is, you pay all those bills, the Rogers, the internet, the this, that. And then after everything is done, then you pay yourself. Well, the concept behind paying yourself first to get to financial independence is that as soon as that paycheck hits, at least a minimum of 10%, take that out, send that to an investment account, close your eyes. It doesn't exist. Like I always tell my clients, you're giving me this money.
Yeah.
It is not going to exist until I get you to your financial goals.
Okay.
Make sense?
It makes sense. So 60,000, at least 10%, regardless of what income you're making, to start off savings to become financially independent, or is that like the max that you should do?
So no, that threshold of 10% is just the minimum, right?
Okay.
And obviously, with just the way that the economy is right now, 10% is not that great, but of course we know that the average person, they are struggling, right? Like 53% of Canadians are living paycheck to paycheck. So therefore that 10% for some people is a lot, right?
So you said 53%?
53%.
So over half of Canadians. Is that like all of Canada or just Toronto?
That's all of Canada, unfortunately. Like, I'm laughing, but I don't think anything's really funny about it. When I really think about the stats, it's actually crazy to me. But yeah, that minimum of 10%.
Surprising. I didn't even know 53%. That's a lot.
It is.
Okay. So apart from saving 10%, what other things can we control to be financially independent?
Another thing that you can control, the biggest thing right now. So I was reading a report recently, and it was an investment executive and Financial Post. They spoke about, you know, Canadians now owing $2.3 trillion in debt. The biggest thing that we can control is debt. If you don't have the money, just don't get that thing, right? Because a lot of us, we just swipe and I'll pay the bill whenever it comes. But if you're not paying off that card 100% at the end of that 30-day period, then don't even use it.
2.3 trillion or billion?
$2.3 trillion in debt.
Where's that money coming from? Who are they owing? That's a lot of money.
That's mortgage, it's credit card, it's line of credit, it's just debt in total, right? So, control the debt. Don't get it unless you absolutely have to, and even then, you know, it's best you use cash.
Best to use cash. So I guess there's good, bad debt, different types of debt. Right.
And this is right up your alley. What we consider good debt, for example, in the real estate world, good debt would be getting a home, right? We consider that good debt because, you know, it appreciates and all of that stuff. Of course, then you sell it, you can obviously earn a profit off of it, right? Bad debt is the ones that I've spoken before. That's that credit card. That's that, payday loan. Those things, avoid them.
That's true. But at the same time, you kind of also need them to help build up your credit to then get a home if you manage it properly. But you said to live below your means. So if you're making $60,000, just to touch back on that point really quick,
Yeah.
what would a good percentage be to be classified as living below your means?
Okay, so obviously,
If you can give a percentage.
it's kind of crazy because I can't generally, there's no one size fits all.
Okay.
Everyone's financial situation is different.
Yeah.
But for that individual who's making, for example, that 60K per year, living below your means means that you're managing your expenses. So you know your income is already 60K. Your expenses, I would say, if you have at least maybe $2,000 a month or less than that, that would be good for you overall, because then you know a lot of that left over you can then put it towards an investment or savings or emergency fund,
Very
right?
true.
But it's hard for me to say, okay, you know what? Everybody, this is what you need to do to live below your means, because everyone's financial situation is going to be different.
And their own personal circumstances overall,
Exactly.
excluding the finances,
Exactly.
is different. So that's a good point. When it comes to the real estate side, just to add a little bit to that, if you are making $60K a year and you have a budget of, say, $2,000 for your mortgage or your rent, putting that into a percentage, you should not be spending any more than about 30% is what I like to recommend on your mortgage or your rent, so that way you could be financially stable and have more room to pay off. Well, more importantly, like you said, to pay yourself first. I almost messed up there. Pay yourself first and then pay your bills thereafter. Let's go to another question that I had gotten for you. This is a good one. A lot of people that I encounter don't actually know about the rule of 72. Can you elaborate on the rule of 72 and what that is, please?
Ooh, I love the rule of 72. I'm such a nerd. Okay, so what is the rule of 72? It basically tells you how long it's going to take for your money to double, depending on the rate of return that you're getting from your financial institution, right?
Okay.
So I believe it was Albert Einstein that said compound interest is the eighth wonder of the world. He who understands it benefits from it. He who doesn't obviously doesn't benefit from it. And don't quote me on that, by the way. But but anyways, the rule of 72. So 72 is the constant divided by whatever rate of return that you're currently getting from your financial institution. That's how long it's going to take for your money to double. So, for example, say that you have, I'm not going to call anyone's name.
Sorry to cut you off. Financial institution, does that include credit unions and stuff or no?
It's more like your bank, where you do your day-to-day banking, right? So, say, for example, that you have an investment account with one of the major banks, right? And you're getting 1% rate of return on it.
Sorry, my face.
I know.
I don't play poker, but go ahead.
1% rate of return. It's funny, you gave me that face,
Yeah.
but when I say that to most people, they're like, oh, yeah, that's good. I'm like, is it? Let's find out. So 72 divided by 1 is 72. What does that mean if we're using the rule of 72? It would take your money at 1% rate of return 72 years for it to double.
You know, the old, you have Caribbean, well, I have Caribbean as a background, you're not, but, you know, the old Jamaican, that's not going to work, at least in my books. But by all means, if that's all you could do, start somewhere. That's the point here. Sorry, continue, go ahead.
So absolutely, when it comes on to rate of return, this is why it's important for people to do their research. So a lot of people are like, oh, well, you know, I trust my bank because whatever the case is. I tell people all the time, I'm like, you trust your bank because of the marketing that they do. Let's be clear. They spend billions of dollars per year, right, to have their television ad, you know, their billboards ad in your face. So obviously you see it more. It plays on your subconscious. I trust my bank. But what you don't understand is that your bank is not getting a 1% rate of return on monies that they get, right? What they do is they shop the world market. They get a 26%, a 19%, and they come back and, oh, you're a good client, so here's 0.05%. Here is 1%. When their money is doubling every 2 to 3 years, every year, your money's doubling every 72, every 100 years, every 1,000 years. I had my money prior to being licensed with one of those major banks at 0.05%. When you do the math on that, 72 divided by 0.05%, 1,440. My money was going to double, and that was my retirement savings. It was going to double every 1,400 years.
Okay.
Do your research when it comes on to investments.
Okay.
And I always tell my clients, we do not advise anyone to have their investments with the banks. It's just a poor vehicle for investments.
Yeah. I mean, you're not holding back any gems by the sounds of it.
I know.
No punches
this is what I do
here. Okay.
Yeah.
So how does debt stacking work? And what is debt stacking?
Okay, so there's actually a few names. So Dave Ramsey, I don't know if you guys know.
I know who that is. Yeah.
Dave Ramsey. You want to tell them who
If
Dave
you know,
Ramsey is?
no, you can tell them. But if you do know who he is, comment down below so we can share the information with everybody else who's watching. But go ahead.
So Dave Ramsey is he's a financial professional. He's been in the industry for over 30 years, right? And he has certain concepts that are so key. So one of them is the snowball effect or the debt stacking method. So the idea behind that is to pay off your smallest debt first. And once that is paid off, then you use that money to pay off your second smallest debt. And you just continue doing that until it builds up. And sure enough, by that time, you get to your largest debt and you'll be able to accelerate that debt payment, right? So for example, for some people, say that your smallest debt is, I don't know, a credit card. It's just $1,000 balance that you're carrying on it. And then you have a student loan of like $5,000. Well, you're going to pay off that credit card first, right? Because it's the smallest debt. It's more manageable. Once that's paid off, you take the money that you were paying towards your credit card, and now you're going to put it on a student loan. And you literally just continue like that until the debts have been walled up and they're gone.
Paid off, yeah. I mean, I've used that same concept for myself, which you don't even know the story. I don't talk about it often, except for to my clients when I need to. But my credit score was horrid, like a long time ago.
Yeah.
It was 432, and I used that same method to pay off my credit that needed to be paid, my debt that needed to be paid.
Yeah.
To then obviously increase my credit score. By the time I got all the small things out of the way, only the big things were left, and I chopped it off really, really quick. So it definitely works. The next question, I'm going to try and stump you because I don't like how you're answering these questions like that. It's not what I expected at all. There is revolving debt and fixed debt, which just looking at that may be a little confusing. So what is fixed debt and revolving debt? I believe is the credit cards. So elaborate on both of those and how they differ, I guess.
So your fixed debt is something, and this is right up your alley, right? Like your mortgage. You know, you have a 25-year mortgage, and the interest rate is probably, I don't know, 3.6, right? I'm just throwing out a number out there, guys. And that, it's fixed until the day that you get that paid off. Your revolving debt is now something like your credit card, your car payments. Those are something that the interest rate can change if you miss some payments.
Okay.
And so it can take longer for you to pay it off. But revolving is because every single month is going to come regardless, right? And that, in a nutshell, is a revolving debt. So those are all of your line of credit, your credit cards, things like that.
Okay, so two questions that just sparked here. So one is, you said that it may go up if you miss a payment. Does that go up a lot, or is it fixed based on how much payments you missed?
It depends on the institution that you're dealing with, right? Like some places, they have a grace period for that client who's never missed anything, and they understand. So maybe for the first two payments, if that they missed, they're not going to increase it. And then maybe after that, say that they had like a credit card of 11.9%. Now they missed two payments, so now it's gone to like 21%, right?
Okay.
But yeah, it depends on the financial institution and the person.
So you definitely should keep that under control.
Yeah, for sure.
Right?
Yeah,
definitely. Because that's more than inflation right now. We're at about 6.8% in Canada. Last time I checked in the U.S., they were at 8%. I just came back from Jamaica. They're almost at 10%. So those credit card bills, you got to be careful.
It's a crazy time we live in.
Crazy time. So you got to protect yourself for sure.
Definitely.
So one of the ways that I wanted to bring you on, to be specific, is life insurance. So before we get into that, because that's a little bit of a teaser, we're still talking about credit and debt. Can you give me 5 common mistakes that people make?
With credit and debt?
Before we get into the life insurance part, yeah.
First one is just getting a card knowing that, okay, they won't be able to afford paying it on so for example, if you know that you have a certain income, right? Like, okay, you only make $1,000 a month and your expenses are like $1,500. When you see that Walmart person coming to offer you a credit card, say no, because it's very tempting. But how are you going to pay for that? So I think one of the biggest things that people make when it comes on to debt and credit is to get something they know they will not be able to afford and they cannot pay for.
Yeah.
You said 5. The second thing I would say is not paying off the balance, or some people can't do that. Okay, I understand the times that we're in. That's fine. But what about just making the minimum payment? That's one of the biggest mistakes too, because most people only make the minimum payment.
Yeah.
Oh my goodness, we just learned about the rule of 72. Don't do that because it's going to take longer for you to pay that card off, right? You got to do at least, if your minimum payment is $200, add an extra $200 on it, right?
So you're at least attacking some of that principle.
Exactly, because that's what most people don't understand. It's like, okay, I just paid $600 on my credit card, but I don't even see my balance moving. Yeah, because it didn't touch a principal. It just went towards the interest, right? So people have to be careful with that. I think another mistake that most people make when it comes on to credit is that they don't control how many creditors they have. So, okay, they have an RBC, they have a BMO, and that's why most people go into debt consolidation because they become overwhelmed. And unfortunately, I've had clients who they reach out to me. Wait, by the way, that's not my fault. They reach out to me after the fact, and I'm like, man, you should have came to me before because now there's not so much that I can do for you. So you really have to manage it. Don't have like all these different cards, your Zellers, your Sears, your this, your that. Like
Zellers.
I know I said Zellers.
That's how you know she's from the U.S. originally. Zellers hasn't been in Canada for what? Sorry, Nick, like 10, 15 years?
Probably 15 years.
That's crazy. So,
whatever, you know.
Yeah, Target. She just said
Y'all
Target.
understand what I'm saying?
But there's
The
no
point that
Target
I'm
here
trying to make.
Sorry, go ahead.
The point that I'm trying to make is just really when it comes on to those credit cards and listen, keep it very simple. Maybe just have one for emergency and tell yourself, I'm not touching this card unless I absolutely have to, right? Because credit can spin out of control very easily.
Quick.
Yeah.
And also to that point, like if the Walmart person is walking up to you to try and get you to apply for a credit card and you could not afford it, if you can't afford it and your credit is already not that great and you get declined for that credit card, your credit score is going to take a hit.
Definitely.
Which is something that you don't want to do, especially in Canada, North America. Credit is very, very important. So you be wary of just saying no when you should instead of saying yes.
Absolutely. And another, I think I'm on 4. So another one that most people make is when their credit card company gives them a call and, oh, we can increase your balance. No.
Okay.
No. A lot of people see that as a good thing, but realistically what they're saying is we see your spending habits and you're always getting close to that limit. We're going to help you out. But the problem with that is most people, when they get it, it becomes like a little appetizer for them. Like, oh my gosh, I'm going to go shopping right now. No, you're not. Leave your card alone. If they increase your limit, I mean, you can take the increase. Just tell yourself, whatever the old balance or increase was, tell yourself, that's it. I'm not going to use this card for anything else because then you get tempted to use it, right?
True.
And before you know it, you've maxed out your credit card.
Yeah, so to add to that point, the only way that would help you is that if you do say yes to that increase, is if you were to set that expectation in your mind, because mind over matter is true and it really does work. Set the expectation if you had a limit of $3,000 and now they increase it to $5,000, do not spend more than, first off, don't even spend $3,000, right? You should only be spending no more than 30%. So I don't have a calculator, was that $1,500 around there, $1,000? No more than $1,000. Whatever 30% of your maximum limit is, don't spend any more than that because that goes against your total debt ratio and your spending limit is low, your credit score will go up, it increases, which will then help you become more financially free in the future because you have, good habits of spending, which is what we're trying to curb right now. So this is the part of the conversation I'm excited for. Because in our culture, like our background as melanated people, Black people, there's a lot of us who don't have this conversation about life insurance.
Oh, let's go there.
Let's go there. So please, table's all yours.
Boy, the table's all mine. You're not going to give them an introduction for life insurance?
I know.
Listen, oh my gosh, I get, honestly speaking, so I don't mince words, I get irritated with our community because, unfortunately, we live for the weekend. Right? So rich and wealthy people, they plan for 2 to 3 generations. Unfortunately, most people only plan for the weekend. And so with that, we don't think about what happens when we are no longer here, right? I have people who say to me, it doesn't matter because realistically speaking, I'm dead, I'm gone, who cares? You have to care because whoever you leave behind is going to, so a lot of people don't know this, by the way. I didn't learn this until I got licensed. Your debts don't die with you.
Yeah.
Right? So if you didn't know that, now you know. Your debts don't die with you. It gets transferred to your next of kin. So in a situation like mine, my next of kin would be my husband. Okay, well, student loan, credit card, whatever else, that's going to fall on him, right? Now, I always ask people, if you don't believe in, we call it income protection, right? Because that's what it is. Life insurance is income protection. It's not for anyone to get rich or wealthy because so-and-so passed away. It's really to protect that income, especially if a person has dependents, right? So dependents for myself would be someone who is 21 or under. Because, you know, kids nowadays, they're living at home longer. They don't want to leave the nest.
Sorry, 21 or 18?
21.
Okay.
21. I did that on purpose.
Just checking.
21 or younger, right? So, okay, you passed away. You have your dependent child. You know, when you were working in here, that money was taking care of that dependent child, right? You also had debts that you incurred. Well, what's going to happen now? Who's going to pay those debts? Who's going to take care of your children? Those bills are probably still going to be coming into your household. How are those bills going to be handled? So I always tell my clients, you know what? You need to protect your income in the event of a premature death or untimely death, because you do not want to have that responsibility fall on your loved one. It's not nice. And by the way, our community, GoFundMe is not life insurance. Okay?
Okay.
It's not. It's not. It's upsetting. GoFundMe, it's not life insurance.
Serious topic. It is not life insurance, but you're right. I digress, though. Continue.
You know? And so when it comes on to insurance, I think the problem that most people have is, oh my God, it's going to be expensive, right? I mean, prior to me being licensed, I probably had the same thought as well. Like, okay, can I actually afford it? How much is it going to be? Because, you know, you don't know about these things. Like, let's face it, financial literacy is not something that's taught in school, right? So we don't know anything about being financially literate. It's kind of like experience, or we hear so-and-so. Exactly. It's trial and error. But when it comes on to the life insurance, the best life insurance to have is a term insurance. And a lot of people are going to fight me probably in your comments section, but at Shen Unstoppable.
Okay.
Please do. Yeah, Shen _Unstoppable on Instagram. Please come. The reason why term is better, and it's not me saying that, the experts agree. So that's Susie Orman, Dave Ramsey, most of these people in this industry, they prefer term and advise their clients to get term over permanent insurance. Why? Because term insurance is, you get 6 to 10 times more coverage, right, for a fraction of the cost. So let me put that into an example for you. So for every $1,000 in premium is what you pay for the years, guys. So for every $1,000 in premium, right, a term insurance would cost on average about $2.63 for every $1,000 in premium. Now with a permanent insurance, for every $1,000 in premium, you're looking at about $26 for every $1,000 in premium. So you can see there's a higher cost for permanent insurance.
So I got one quick question for you.
Yes.
Term and permanent is what you said, right?
Yes.
How long is a term exactly?
It depends on the institution, again, that you're with. So the company that I represent, for example, our maximum term is 35 years. I'll put it like this, because there are people who love permanent insurance and they just cannot part from it, right? Put it like this. Do you believe in paying for a house for the rest of your life?
No.
Okay. Do you believe in paying for your car payment for the rest of your life?
No.
So why would you want to pay for life insurance for your whole life? It's a temporary need. Put it like this. In the early years, like for us, right? We're millennials. In the early years, we have a mortgage, we have dependent children, right? And so the loss of income would be devastating to a family like ours. However, in the later years, the children are grown, they've moved out, the mortgage is paid off. So now that you're older, what do you need?
Insurance?
Wrong. What you need is money. You're going to need money to retire. I don't care how good your life insurance policy is, you can't spend it.
Yeah.
Right? And so we just spoke about inflation right now is at 6.8% in Canada. Well, progressively, things are getting more expensive. You're going to need money to retire. So the thing that I do with my clients, I protect my clients against two very real risks. That's the risk of dying too soon and living too long.
Okay.
And that's called the theory of decrease in responsibility, because how life works is in the early years.
Sorry, you said living too long?
Yes.
Who dictates that I'm living too long? Like,
I love that question because I love when people ask
oh, you
me
set
that.
me up again.
I definitely
All right, go
did.
ahead.
Who dictates if you live too long? Your money does.
My money dictates if I live
Your
too
money
long.
does.
Okay.
Ask me how.
How?
Well, for example, say that you have maybe 250,000, okay? And you said to yourself, okay, this money's good. It's going to last me probably until age 89, 95. I'm going to be good. What happens when you live beyond the time that you stated this money's going to last for? Did you know that you can outlive your income?
Never thought about that.
So what happens at age 110, 115 when you lived a little bit longer? Are you going to go back to work at that age?
I hope not. I think my bones would break or something.
Right? Because how did God create us? He created us that as time passes, things start to deplete, right? We don't get better with age. Unfortunately, we get worse health-wise.
Yeah.
And so if you said to yourself, I have this much money and it's supposed to last for this much time, but you live longer than that, now what are you going to do?
Okay.
So that's a theory of decreasing responsibility.
Okay. So then you said that there is a misconception out there that I've seen throughout social media, whether it's Instagram, YouTube, TikTok, that people get life insurance and they're able to take that to invest and do other things with it to increase their portfolio. Is that not true?
Yeah. Okay. So TikTok is to be blamed for this one. And so is Instagram, because you have a lot of people who, you're not licensed. Please stop speaking on something that you don't know anything of. Just because it worked for you doesn't mean it's going to work for someone else. Okay, this is the licensed professional saying this. So first and foremost, a lot of people, they love permanent insurance and they cannot part with it. Why? Cash value. So let's break down a cash value. That's the investment portion that is attached or built into the life insurance. And that's what you pay for. That's why it's so much more expensive than a term policy. Okay. Now you have people who are like, oh, well, I can take money out of my cash value. No problem. Here's how it works though. So tell me, actually, I want to ask you a question.
Okay. No, but it's not supposed to go that way.
It's going to go that way.
What's the question?
It's going to go that way. So let's say you come to the Gordon Bank, right? And I tell you, all right, you know what, Maurice? Thank you so much for doing business with us. We greatly appreciate your business. And so I just want to let you know, for the next 5 years or so, any money that you put into our bank, and it's not going to go to your account, okay? And by the way, we're actually going to take that money and I need to pay my overhead. You see my lights, they got to stay on, and the AC, right? So I'm going to have to take that money to do that as well. And oh, yes, by the way, if you try to take money out of this, I'm going to charge you an interest of anywhere from 6 to 8%. But you're okay with that, right?
You see, I already made the face. I would walk out immediately, halfway through your conversation.
That's how your cash value insurance works, by the way. Okay. That's exactly how it works. Because what people don't understand is that, yes, you take money, but once you read that policy, you're not taking money out of your money. It's called a borrow against the loan. You're actually borrowing your own money, and so you have to put it back. And they usually charge anywhere from 6 to 8%. And if you decide, this is my money, that makes no sense, I am not putting it back, no problem. When you, the policyholder, passes away and your beneficiary goes to get that check, say that you took out $5,000 out of the cash value and your face amount is $100,000. They're just going to take that $5,000 out of the face amount and they're going to give the $95,000 to your beneficiaries. But what people don't understand is you pay for two things your whole life. That's why one of them is called a whole life policy. You pay for two things your whole life. You pass away, your beneficiaries either get to get the cash value or the face amount. They don't get both. Is that fair?
Doesn't sound fair at all.
So that's your permanent insurance policy in a nutshell.
I mean, a portion of that sounds like a TFSA and a RSP, how they kind of differ. Because we were talking about how we can diversify, financially manage ourselves better. Are you able to speak on, how a TFSA and a RSP could help in these situations as well? Yeah,
so it's better. So we teach our clients, right, buy term because it's cheaper and more people can afford it, and invest the difference. So what does invest the difference mean? Well, typically, like I mentioned before, in $1,000 scenario of the premium, right, we know that the permanent insurance would be about $26 for $1,000 in premium.
Okay.
Right? So if you're getting the term, it's more affordable. Well, I have clients, say for example, you're my client and you have a permanent insurance policy, you have $150,000 in coverage. at your age right now, that would probably cost you about $250
I'm only
or
like
so.
25, so.
Okay, me too.
Yeah.
So, so that would cost you about approximately $250. Well, if it was a term policy, $150,000 would cost you about maybe $70 or so.
Okay.
So we teach people to invest the difference between what you would have been paying for your permanent insurance policy and the term, right? So now let's go to the investments. There's two types of vehicles. You have the TFSA, guys, that stands for tax-free savings account, and then you have the RRSP, the Registered Retirement Savings Plan. Now these two have their different mechanics. They work differently, and it depends on the person's goal. Now, a lot of people, so with the TFSA, it's after tax dollars, right?
Okay.
And with the RRSP, it's growing tax sheltered. So it depends on what the person's goal is. What we do when we sit down with our clients, we do what's called a Know Your Client tool, a KYC, because I have to know what's the time horizon. When are you going to need this money for? What's your risk? You know, can you take a lot of risk? Can you not take a lot of risk? I have to know certain things. If someone says to me, this is a short-term goal that I have, well, you know what? Let's go the TFSA route, because what people don't know is that, well, most people know this anyways, there's a penalty, right? And so you will have people that say to me like, oh, Shanecia, did you just tell me to do an RRSP? I'm not doing an RRSP. When I took money out, they charged me. Absolutely, you got charged. Yeah. And quite frankly, you should get charged. It's called a retirement savings plan for a reason. Yeah. You didn't retire. Why are you taking money out of it? Right? I know. And with the RRSP, I think you should know this. So the government actually changed the rules recently. Before it was $30K. Now it's about $50K. You can take money out of your RRSP to do the home buyers plan. I think that's one of the beauty of it. Definitely. With the RRSP. With the TFSA as well, because it's after tax dollars, your contribution, a lot of people are not maxing out their TFSA's contribution or their RRSP. But like I said, you have to sit with your advisor to know what your goals are, and they'll let you know which way you should go, if it's the TFSA route you should go, or if it's the RRSP, because it depends on your goals, right? Okay. And again, I can only generally speak. I can't give specific, because everyone's situation is going to be different.
True. What are 3 reasons why you should never buy life insurance?
What are 3 reasons
why you should never buy life insurance?
I love that question. You know why? Because life insurance is a need-based product.
Okay.
So some people need a lot of insurance. Some people need a little bit of insurance. And believe it or not, some people don't actually need any insurance.
No life insurance?
Nope. Some people don't need it.
But they're living, though.
Exactly.
Okay.
So in the case of someone not needing life insurance, this is because it goes back to financial independence, right? So if their net worth is $2 to $3 to $5 million and they have assets, they really do not need the life insurance. The reason for this is, okay, say for example, one of their portfolios is like $10 million. And we know the average cost of a funeral in Canada is $30,000, right? So you have your funeral and burial expenses. Depending on the type of burial the person wants, it can get more expensive, right? But if they want something just simple, then realistically speaking, that portfolio is worth $10 million. Okay, you knock off maybe $40K to bury, that person. They still have money left over. True. Right? Yeah. And if their children are grown and they don't have dependents. Above 21. There's a reason why I said that, but y'all got to find me to know why. But yeah, if they have a certain amount of assets and their net worth is in the millions, they don't need insurance, right? It's not a need anymore. Maybe it's a want, because some people are like, I don't want to touch my money at all. Let the insurance policy take care of that. That's fine. But in that scenario, they really don't need insurance. So that's 1. And you said 2?
I said 3.
2 more.
2 more, yeah.
So what are some, okay, if the person is unemployed.
I mean, you can't pay for it, right?
Exactly. If you're unemployed and it doesn't make sense, maybe you need it, but if you can't afford to pay for something, it doesn't make sense.
Let me ask you this, side question. So with regular insurance, like car insurance, if you are neglectful on a payment return, it gets canceled, good luck getting car insurance anywhere else. Is that the same with life insurance?
No, absolutely not. Because we've had clients who've elapsed their policy because their financial situation changed. Maybe they lost a job or they got a divorce and it was very expensive. And so I'm like, okay, let's just meet together. We'll do the paperwork over and okay, we'll pick up where you left off. The only thing about that is keep in mind there's something called an insurable age, right? So for example, if you're within 6 months of your date of birth, your insurable age, say you're 25 right now.
Yeah, be 26 to the company basically. Yeah, I'm 25. That's not what I said. So, you know what it is.
Exactly. So your insurable age, because you're within 6 months of your date of birth, your insurable age would be 26, right? Another reason why someone may not need insurance is, you know, relatively they are good at managing their money. And so everything is up to par with their debts and all of that stuff. And they have no dependents. If you have no dependents, I wouldn't say that you don't need insurance, because I always tell people, you know, when you're young, how insurance works is just like having fun. The younger you are, the cheaper it is. The older you are, the more expensive it becomes. So yeah, you should probably get it to lock in certain rates, right? And remember, your health situation can change because you can go from being insurable to not insurable. But if you don't have dependents, I wouldn't say that you actually need it. And I have friends in my circles, or acquaintances, I should say, who they don't have insurance because they're like, I don't have a wife, I don't have kids, I'm good, I have money in my account. Why would I need insurance? No problem. You don't need it actually. But when you do get those responsibilities, you need to call me.
Yeah. Talking about that, let everybody know exactly how they can get a hold of you and where they can get a hold of you.
I'm on most social media platforms. So I'm on LinkedIn, Shanecia Gordon, and
1 second. It's not a common name. Could you spell it for them?
Oh, you know what? I was going to do that, but I thought y'all was going to put it in like We'll
do both.
Thank you. So that's SHENECIA, last name GORDON. And then on Instagram, it's Shen Unstoppable. So that's SHEN_unstoppable. You don't know how to spell it? You want me to spell it?
No, we good. We good there.
And Facebook, Shanecia Gordon. Twitter, Shanecia Gordon.
Phone number, email address?
Yep. Phone number 416-464-3035. My email address is ShaneciaGordonFinance@gmail.com.
If we have any more questions, check in the comment section. Shoot me a DM. Shoot her a DM. Add her. And great to have you. Hope we can have you back another day. And thanks for coming. Appreciate it.
Thanks for having me, guys. Bye.